Here's a quick recap of the week before everyone hits the roads and skies for the 4th of July weekend. The truth is, stability in energy is always temporary, like drilling sandbars in a shifting river. You're never certain how the ground will hold you until you put your weight down. I'm Mark Roach, and this is FutureWise Energy, here to cut through the noise and deliver hopefully a real-world read on the U.S. upstream sector as we cross into July of 2025. Let's take the pulse in Texas. Upstream oil and gas companies aren't sitting still. In May alone, 2,200 new jobs came online, and the state's workforce swelled by 5,000 positions year over year. Hard numbers, not just headlines. That's more than just hiring. That's a renewed vote and confidence in Texas as a linchpin in the broader U.S. energy supply. When the world wobbles, a surge like this says plenty to anyone with capital at risk. But high output isn't just a Texas story. The EIA projects U.S. crude to average 13.52 million barrels a day for the quarter, a new watermark forged by advances that wouldn't have been possible even 5 years ago. When digital analytics and field acumen merge, efficiency stops being a buzzword and becomes the best defense against volatility. Yet before anyone claims that we're running downhill with the wind at our backs, take a sober look at the activity on the ground. The Dallas Fed puts it bluntly. The second quarter brought contraction in drilling and completion, a consequence of whipsaw tariffs and price uncertainty echoing through boardrooms and break rooms alike. This isn't new. We've seen before how momentum can vanish when leadership trades optimism for caution. But as always, the edge goes towards those with discipline, enough discipline to adapt while others blink. Globally, investment tells us a cautionary tale. Upstream spend is expected to drop 4% this year, another marker of how recent shocks have forced operations to tighten their belts and reassess priorities. Here's the rub. In the business, nimbleness isn't luxury. It's the ticket to survival. Those who cling to the last decade's playbook will be left counting missed opportunities. And policy never sits idle. July brought an end to U.S. sanctions on Syrian oil imports. The direct impact to our own upstream breakouts is muted for now, but the ripples these regulatory shifts send through global trade lenses can pivot market realities fast. Wise leaders will keep an eye on the horizon, not just the next step. Zoom out, and the trend comes into focus. Higher turnover rates nag operators. Even as hiring surges, deep water is drawing hard new capital, especially down in the Gulf. And those who mistake sustainability for a press release haven't been watching. Where dollars are moving, real investments are being made in the emissions-cutting tech and carbon management. Meanwhile, Permian midstream bottlenecks, long a thorn in our side, are easing as new infrastructure goes into making natural gas movement smoother than last year's logjam. Here's the core message. As always, transparency and adaptability are the real currencies in play. The American upstream sector isn't immune to global shakeups or shifting regulation, but it's built on a legacy of resilience and smart risk-taking. The winners won't be those who wait for clarity, but those who dig in and adapt and move before consensus forms. If you see a sleeper trend or a wild card on the horizon, let's see your take in the comments. For energy insights grounded in experience, not just theory, subscribe and join us. Change doesn't scare us, complacency really does. The tectonic plates beneath energy are shifting, and what defines us is whether we rise to meet the tremors. I'm Mark Roach, and this is FutureWise Energy, wishing you all the best. Enjoy your 4th.